All right, and we are live. Hello, everybody.
Hello.
Welcome to the Peak Prosperity Real Estate webinar. We're doing this in partnership with Russell Gray and Robert Helms, also known as the Real Estate Guys. These are real estate experts that we have known for many years now. We've spent a lot of time with them at different events around the world, including their excellent Summit at Sea, which we'll talk about at the end of the webinar. But where real estate professionals and experts spend 10 days together on a beautiful cruise going somewhere wonderful, usually in the Caribbean. So we have a multi-series a multi-episode webinar series that we are kicking off with today's free webinar. This one is going to focus on the macro reasons for why investing in real estate versus other different types of asset classes. The series itself is called Investing in Real Estate for Safety and Profit. So we're going to have Russ Gray kick us off here in just a moment. Before he does, I just want to go through a couple of housekeeping rules. We're going to keep this webinar to about an hour and a half, hour and 45 minutes in length, just for those of you who are planning out your day. If you look to your right on your screen, you should see a chat window. I see people are already beginning to chat in there. If you get a moment, just share your name and where you're from. We always love to see where our audience is piping in from. But during the course of the webinar, if you have questions, post them there. We've got a couple hundred people watching, so I'm going to apologize in advance that we're not going to be able to address every question. But where we can, I will surface them up for Russ. And once the main presentation's done, which will take about an hour-ish or so, we'll leave about 45 minutes for purely open Q&A, and we'll get to as many questions as we can. Just a reminder to everybody, there will be a replay video of this event sent to everybody once it's completed. So if you need to get up and make a sandwich, attend to children, or can't make the whole webinar today, don't worry. You'll get the replay video. You'll be able to rewind and fast forward to your heart's content. If you have any technical issues, just mention them there in the chat window, or if somehow you get booted out of the seminar and can't get back in, just send an email to support@peakprosperity.com. I'll be monitoring both and we'll help you there. Just a quick note, technologically, we've got this down pretty well to a science, but every once in a while, either you as an audience member might get booted, or even one of us as the presenters might get booted due to a glitch in a broadband connection. If that happens, just return to the link that you received in your email and log back into the webinar. If for some reason one of us speakers goes blank for a moment, hopefully we can all just be patient, and within about 30 seconds, we hopefully should be able to pipe back in. So if one of us goes blank, don't immediately shut your browser down, assuming the webinar is over. We'll get it corrected. But with that being said, I want to return back to Russ. Russ, welcome. First, thanks for joining us.
Yeah, thanks for having me.
Well, you're very welcome. And as you're aware, you've heard the Peak Prosperity message delivered a lot. I know you've read our book Prosper an awful lot, and you've heard us talk about the importance of really moving through the three different types of wealth: primary, tertiary, and secondary wealth. Most people have their wealth in what we call tertiary wealth, which are paper investments, paper claims on things. We always recommend that where possible, people are moving down that spectrum and owning more of the actual tangible assets themselves. Things that can't be inflated away easily, things that can't be hypothecated or rehypothecated. You've also heard us talk about the wisdom of developing multiple streams of income. Ideally streams of income that adjust with inflation. And towards both of those objectives, real estate is a time-honored solution. And Chris and I have talked about the fact that we really want to make sure that we are educating the Peak Prosperity audience better than we have in the past in terms of real estate, and it's less known to the majority of people than things like stocks. It's very easy to go out there and buy a stock with a click of a mouse. It's a lot harder to buy a real estate investment. There are just more steps to take. There's more complexities to get involved. But like anything with practice, you get better at it and you're able to unlock more and more value. And real estate by itself is, not all properties are created equal. There's many different ways to invest in real estate. I know that you don't like people to refer to it as an asset class because there's so much variability in there. So really what we want to do with this webinar series is begin to educate people about the nuts and bolts of the real estate process, to be able to arm them with the knowledge and the education so that they can actually go out and start applying this in their own life. As we've written about, to be very fair, here at Peak Prosperity, we have warned people about current overvaluations in a lot of different assets because of the everything bubble, as we call it, that's been blown. So I'd love for you at some point in this presentation to talk about how we can tell when it's a better time to buy real estate versus not. I know a lot of people watching this are concerned that if they were to jump in now, they might be buying at the top of a market. I know that in all markets there may be values to be had, but certainly there are macro trends to watch out for that create better valuations in general. So I just wanted to flag for people that that's another dynamic that's in play here. So, with that being said, Chris, I'll let you just chime in real briefly because I know that you've spent a lot of time, as I have, with Russ and Robert, and just let you give a sense for anything that you want to add to what I said about why we're doing this. And then we'll hand the podium to Russ, and Russ, you can start the presentation.
Well, certainly, and thank you for that. Thank you, Russ, for being here with us today. And thank you for everybody who's logged on right now. I just was, you saw my eyes darting over. I was just scanning people. We're very helpfully saying where they're from. We have somebody logged in from Germany today. We have people from Canada. We have somebody from Trinidad, all over the United States. So there's a lot of interest in this, and I see a lot of excitement. People are pretty keen to dive into this area. And of course, they really should be at this point in time because real estate is a complex area, but not that complex. It can be unpacked and solved. And it took me a number of trips with yourself and with Robert on the cruise, of course, which was a fantastic learning environment for it really to get baked into my head, because I was holding some beliefs that I wasn't aware of that had been implanted around what a house is. I think it was really Robert Kiyosaki first, a number of years ago, arguing pretty strongly that a house that you own and live in is not an asset. It's a liability, making the distinction that assets put cash in your pocket and liabilities take cash out of your pocket. And that was a head scratcher for me because everybody had told me this is your biggest asset you will ever own. And when I looked at it from this other direction in terms of cash flows, light bulbs started to go off. And those are the light bulbs we want to bring to our tribe here today. So I'm really excited that you're here to do that. Thank you for that. I'm really going to be in learn mode again because it turns out I can't hear this stuff often enough for it to really sink in. And that's what's involved in deprogramming a belief system. It takes time. It might take multiple exposures to the idea for it to really settle in and finally get to a point where it's kicked the old one out and now it's a different way of looking at things. So that's really what I know you can bring just extraordinarily. So with that, that's all I have to say. I'm in learning mode here today. I'm going to be taking notes, and I just want to welcome everybody who's here. And if you have questions, the way this is going to work, as Adam said, there's going to be a presentation, and then there'll be time for some Q&A afterwards. As you're logging your questions, I'm going to be doing my best to capture them. Adam will as well, and we'll see how many of those we can get to. We may not be able to get to all of them, probably won't, but ask them and we'll see if they fall into buckets, and we'll see if we can get a summary question out of 10. And that's how we'll go from here. So with that, welcome everybody, and let's all get our listening ears on.
Is that a toss to me then? Ready
Sure.
to go? Yeah,
absolutely.
Okay. Well, so first of all, thanks guys for having me. It's just an absolute privilege. I started out just, I'm an information junkie, and I've been listening to the Peak Prosperity Featured Voices podcast for a long, long time. Heard about the Crash Course, obviously been friends with Robert Kiyosaki for quite a long time now. And anytime he follows somebody or talks about somebody, that's on my short list of people to follow, pay attention to, and hopefully meet. And so, the opportunity we had to bump into each other at Freedom Fest a few years back and get to know each other has been great. I always felt like I knew you because I've been listening and reading your stuff. And you really filled in a big blank for me. And I think that for everybody on today's webinar, and I'm going to share a little bit in kind of the formal presentation about my background and how I got here. I've clearly not done everything right. In fact, probably most of the smarts I have today are from the things I did wrong. And if I could go back in time and talk to my younger self, having been through a few recessions, having been through the great financial crisis, having um, not listened to a lot of the smart people that had my ear but not my attention. I'm going to be saying some things that I think that you need to hear because they're the things that I'm doing, the things that I've learned. You know, there's a section in here called Lessons from the Recession. And there's a lot of great lessons. In the beginning, I was bitter and I was upset and I was blaming. And then one day I woke up and owned it. And it really helped. It helped a lot. You have a lot more control over your future than you realize. There are certainly macro forces out there in the economy and in the world that are kind of taking your little ship on the ocean, the economic ocean, and battering you a little bit. But there's many, many things you can do. As you're about to find out, my goal in today's session is to help people understand that real estate is both real and resilient in the kind of wealth that it brings. And I'm going to blow up some paradigms that I had going into my first foray into real estate. And a lot of those paradigms is really what hurt me. I was taught a long time ago, and I found this to be very, very true. What you think and what you believe affects exactly what you do. And what you do affects the results you produce. If you want to change your results, you got to go back and start with what you think and believe. And so after 2008, I kind of threw everything I thought I believed in the trash can and picked back out the stuff that held water and tossed the stuff that didn't and went looking for new and better ideas from people a lot smarter. And I'm going to introduce everybody to some of those people. Obviously, you guys have spent time with some of my mentors. And I'm just proud to call you guys friends and to know that when things happen in the world, I can pick up the phone and we can have these conversations and rub our brains against each other and pick up different insights and perspectives because we all are looking at what's going on in the world through a slightly different lens. So anyway, now I guess I'm going to jump into the screen share. Is that right, Adam?
Yeah, go right ahead.
My tech guide. Okay, and I'm going to share this screen. There we go. And then I'm going to minimize. Let's see. Forgive me, I'm definitely not a tech guy. All right.
You're doing great.
Okay. So now am I showing up like a little thumbnail in the corner and everybody's seeing my main screen?
Yes.
Perfect. Then I will be conscious that I'm on camera and won't do anything weird. So today's session is called The Case for Real Estate Investing. You guys already know I'm Russell Gray, co-host of the Real Estate Guys show. For those of you that aren't familiar with the Real Estate Guys radio show, we've been broadcasting on conventional radio since 1997. That's when Robert Helms founded the show. I wasn't in the picture back then. But since then, we've had over 12 million listens, over 2 million unique downloads. We didn't start podcasting until almost 2010. And we're heard in over 190 countries. It's just an amazing thing. So if you're interested in the show, you can find us pretty easily on iTunes in the investing category or on any of the popular podcast platforms, probably the same places you find the Peak Prosperity podcast. So that's a little bit about that. The series we're in, as Adam said at the top, is Real Estate Investing for Safety and Profit. This is part one. We don't exactly know how many we're going to do. We kind of have a scope and sequence that we're going to cover at the end, but we really are going to pivot a lot off of your questions. So, as Robert and I are preparing this content, we don't actually know the Peak Prosperity audience as well as we know our own audience. And so we've made some assumptions. And we've certainly met some folks, and many people in our world have gone over into Chris and Adam's world because there's a lot of cross-pollination in the circles we run in. But I just don't want to assume that you guys, understand things or think about things or don't have certain prejudices or backgrounds or whatever. So if you have things you came wanting to learn, get them out, and then we will shape the rest of the series really to cater around the things we think you need to know and also addressing the things that you tell us you want to know. One thing about this concept of safety, I probably don't need to tell you this, but nothing is safe. Sitting in cash isn't safe. Hiding in gold isn't safe. Doing nothing isn't safe. There's no such thing as safe. If you draw a breath, if you live in this world, you're not safe. So really what you're doing is you're in the business of mitigating risk and analyzing where the threats could come from, where the opportunities are, and putting yourself in a position to take advantage of what the market is giving you, what you're willing to do, what you're not willing to do, what you enjoy, and what you providentially end up having opportunity to do. Sometimes you meet the right people or you end up in a relationship. I couldn't have scripted meeting Robert Helms. That just happened. but I was open to the idea. And many of the relationships he and I have formed together since we've been working together, we couldn't have scripted, but we were open to the idea. And it's because we knew what we were looking for and what we needed. So our goal in real estate is, in this presentation, is really talk about how real estate is a reliable vehicle for building real, resilient wealth. And of course, you get to be the judge. I'm not here to tell you I'm right. I'm only going to share my ideas and opinions, and that's really all they are. But the reason understanding the vehicle and the context is a lot more important than the nuts and bolts of how to do real estate at this stage in the series is because if you don't trust the vehicle or don't enjoy operating it, you're not going to bother to do it. And so it doesn't matter. And so a lot of times people will start on a path and they'll get involved in something because somebody else likes it or somebody else did well in it, and they'll do it. And then they'll wake up one day like I did in the insurance business, and I was unhappy. I didn't like being in the insurance business, but there were people making millions. And in the beginning, that's what I thought I wanted. I thought, well, if I could just make enough money, then I can have whatever I want. I grew up a little bit from that, and I realized, hey, you know what? If I can find a way to monetize what I enjoy doing, that's a better life. And then if I can find a way to monetize in a resilient way what I enjoy doing, that's an even better life. And so I've used real estate to create that for myself. I'm going to lay out to you some ways I've done it and how I think you can do it too. And, just so you know, it's not going to be a lot of nuts and bolts today. We can get into that stuff later, but this is just going to be laying a foundation of what real estate is, what it can do, how it works compared to some other things against the backdrop of what's going on in the world right now. So it's a lot of it is about perspective, and you may be here thinking you understand real estate. I know I thought I did. I'd already had some success in real estate by the time I started meeting some really much higher caliber and more advanced real estate investors. And for me, it's always challenging because I don't exactly know who I'm talking to, but I've talked to hundreds, maybe thousands of people about real estate investing. And I can tell you, most people really don't understand what real estate investing is or can be. Chris mentioned at the top that he had a way of looking at real estate, and then he met Robert Kiyosaki, and Robert Kiyosaki opened his mind up. And then I didn't listen to Kiyosaki when he first started talking to me about what was going on leading up to 2008. And because of my beliefs, my thoughts, I acted a certain way. I did not build a resilient portfolio, and it ended up being very painful for me. So I wish that I would have known some of these things. So I think it's just important, if I'm going to sit here and share with you ideas, you have a little bit of an idea where I'm coming from. And one thing, just by way of disclaimer, nothing I'm saying today is investment advice. They're just ideas and perspectives. Two friends talking over the back fence. You always want to check with your own qualified advisors before you actually go out and do anything. And there's lots of good information out there, and there's lots of good people out there who can help you. So I grew up in Silicon Valley. This is actually an orchard I used to hike through to go to school. You can believe it's not there anymore. Silicon Valley back then wasn't called Silicon Valley. It was called Santa Clara County, and it was the fruit packing and canning hub of the world. And it was just a lot of orchards. It was a quiet little town. But I grew up in it as it became Silicon Valley, and I watched that happen. In fact, my dad was a high-tech entrepreneur. I was raised by an entrepreneur, and you can't really make all this out, but the genealogy is back here with Fairchild and some of the early semiconductor companies. And in 1981, my dad started a high-tech semiconductor company. Eventually, he took it public at a very inopportune time, and I'm going to tell that story in a minute. But his experience shaped mine, and it's really a big part of why I'm here sharing with you today and why I feel so strongly about financial education, why I feel like I do about Wall Street, and why I feel like I do about real estate. So that's just a little bit about where I'm coming from. This is the first property I ever bought it in 1979, brand new. I was 19 years old at the time, and I paid a whopping $72,000. And this is what it looks like today. In dollars, it's worth about 10 times what I paid for it. So we say equity happened. But the funny thing is, it's pretty much the same square footage. It's on the same size lot. It really doesn't look 10 times better than when I bought it, and it doesn't sleep 10 times as many people. So from a real value, a utilitarian perspective, it didn't get any better, and yet it's worth 10 times as much. So we're going to kind of address that a little bit going forward, but it just gives you an idea what happens to the measurement of value when you can't count on the unit of measure. And in this case, the unit of measure is the dollar. This is the second investment, or this is my first investment property. And I bought this one in 1985 for $130,000. You're going to be shocked when I tell you what it's worth. It's worth $1.3 million today. That is Silicon Valley for you. And so again, equity happened, and it doesn't look anywhere near as good as when I had it back then. So, but the thing that happened for me is I was making money in some regards, almost accidentally. I became really fascinated with financial strategy, especially, I looked at real estate. I thought, God, what would happen if I tried? And I thought if I could find a way to combine my working life with my investing life, that would provide me some time leverage in my career, because most of us do what we do to earn money, and then we invest part-time, which takes up our spare time. I thought, well, if I could find a way to combine those two things, then I could do both, get paid to invest. And so I decided to do that. But strangely, I didn't gravitate towards real estate. I mean, I went and got my real estate license, but I really honed in on the insurance business and then the securities business, and opened a small financial services office in Silicon Valley in the early 90s or the late 80s. Anyway, and I learned a lot about financial planning going through all that. Anybody that gets a chance to know me knows that I'm just a voracious student. I'm never satisfied. I'm always learning. And I study business, I study economics, I study investing, and especially financial strategy, how to get more out of what is there on your balance sheet and your cash flow statement. So I guess you could say I'm a little geeky in that regard. I was in Silicon Valley in 1987. 1987, you may recall, some of you are old enough to remember, we had the Black Monday, the October 25% crash of the Dow. It was the big, big crash. I was in the securities business in 87 when that happened. And I watched my father, who had just taken his company public 6 months earlier, lose his $12 million fortune in a matter of days. And so it took me a little bit, but I got out of the business because I completely lost faith in that vehicle. I no longer trusted Wall Street. And it was really my first personal experience with what happens to people at a human level when there's a devastating shift in a market and people aren't aware it's coming. That blindsided my dad, blindsided his advisors, it blindsided a lot of people. In Time magazine, you can see from the cover of I think the week later edition, they knew the world had changed. But I didn't really understand why or how until many years later. I just knew my dad's dream was shattered, and it changed him, and it changed me. So I quit repping Wall Street. I went back into corporate sales for 10 years to support my family and kind of just incubate while I regrouped. And I spent those 10 years studying the financial system, trying to figure out what happened and why. And I also spent those 10 years and more watching my dad flounder. He never bounced back. Too much of his self-worth was wrapped up in his net worth. And when he lost his net worth, it took his self-worth with him, and he was just never the same man. And so I watched that happen, and I made a vow. And I vowed that if it ever happened to me, I would separate my self-worth from my net worth, and I would bounce back. And I guess today, after studying with Chris and Adam, you'd call that emotional capital. My dad didn't have much emotional capital, and I'm not criticizing, I'm just saying the way it was. And he didn't have much social capital. So when the crap hit the fan in his life, he didn't have anybody to call. He didn't have people like I have, Robert Kiyosaki and Brian London and Chris and Adam and Peter Schiff and G. Edward Griffin. And I have all these people and Main Street investors whose names you wouldn't know, but are super, super smart. And I can pick the phone up and call them and talk through the issues. So that was a big lesson. I have that today because I got that lesson in 1987 and went about developing those other forms of capital, even though I hadn't read Chris and Adam's book because it hadn't been written back then, but conceptually I understood the value. And all that really led to me to come home to real estate. I had tried in my late 30s to be a stock trader. I had dreams of starting an investment fund. I was going to teach people how to day trade because I thought it was fun. But I was doing that in the run up to the .com bust. And then when it busted again, that was my second stock market bust. then I just decided that Wall Street couldn't be trusted. I wasn't, 1987 cleared me of the notion of being a buy and hold investor. 2000 cleared me from the idea of even trying to be a day trader. Um, I know people do it and they do it successfully. I realized it was a time trading a time for dollars. So that checked it off my list. I was looking for more time leverage in my investing. There were some other flaws with it. I'm going to talk about that in a minute. That the round trip just ended you in cash. I never built any resilient wealth. I just ended up with piles of cash. So there were a lot of reasons why I didn't like it. So I decided to come home to real estate. And what I didn't realize is there was a lot of people who'd been burned in the dot-com bust that decided to come home to real estate also. And so I had been in my corporate job for 10 years. I decided to leave the corporate job again. But this time, instead of going into the paper side of it, I decided to go into real estate. And I took what I learned in financial services and looked at the asset allocation models of demographics. I read Harry Dent. And Harry Dent talked about demographics and their impact on economics. And I thought, wow, this is fascinating. And so I looked around at things I was interested in, things I knew. And I said, well, I can see the baby boomer demographic. And based on what I've learned in financial planning, when baby boomers begin to gravitate from equity growth to income, they're going to shift from stocks to bonds. And as they go into bonds, that's going to create money into bonds, bringing the bond bid up, which should press interest rates down. And I already knew interest rates had been falling. I just didn't understand why. And so I ended up saying, well, if interest rates are going to drop, then real estate would be a beneficiary. And if I was in the business of brokering financing, there would be lots of business to do, both in refinancing and helping people acquire and manage equity with their investment portfolio. So that was my theory. It was kind of a very simplistic theory. I got it right for the wrong reason. But all that to say, what I ended up doing was going into the mortgage industry. So I wasn't really a property guy. Anybody that knows me knows I'm not really a real estate guy, even though I'm a real estate guy. I'm more of a finance guy. I always have to partner with people that like to go look at properties and do the deals because that's just not my thing. And so if you're out there and you're thinking, I don't like the idea of driving neighborhoods or walking properties, so I would throw real estate investing out the door because I don't want to do that. I'm here to tell you, you can do real estate without doing those things through strategic relationships, through partnerships. You can be hands-on if you choose to, and there's some reasons to do that. I did do some hands-on real estate investing at one point in my life. But if that's not your thing, don't feel like you have to do that. The one thing also I knew is in order to play big, I really had to understand financing. So that was another motivation for me getting into the mortgage business. So I started this mortgage company in 2000. And I decided that because I was fairly well studied and I felt like I had a unique proposition in the marketplace because I had a little bit of financial planning background, I had a little bit of economic training, and I felt like I could bring financial strategy to real estate investing, and I could lead with education and create clients for my mortgage business. And I'm no longer in the mortgage business, so just so you know, I'm not doing this today because I'm hoping you call me up to do a mortgage. I don't do that. I don't sell real estate. That's not my thing. I like to teach. We have some events that we do, and we do our own investing offline. But that's not my motivation in being here today. But anyway, so I decided that my mortgage business, I would specialize in working with investors. And so I went into the marketplace and I started investigating seminar marketing as a way to find clients. And that's why I ran into this guy. The guy on the far left there is Robert Helms. He is the host and founder of the Real Estate Guys radio show. We've been in business together now for about 17 years. I've known him for 18 years. I am the fellow on the far right in the dark blue shirt. Those of you that know me today know that I don't look anything like that today. This picture is about 15 years old. I was trying to find a picture of about when I met Robert, and this was the earliest one that I could find. But this was right about the time that I became the co-host of the Real Estate Guys radio show. And, we released our book 6 months later. We built together this thriving investor mentoring club where we had a big group, almost 1,000 people that we would meet with monthly. And we would just mentor them on real estate investing. We got a TV show. We ended up becoming the most popular TV show on the Success Training Network, where we were on with people like Tom Hopkins, Zig Ziglar. The gentleman in between us there is Jim Rohn, the late, great Jim Rohn, great personal development trainer. So the point is that through a strategic relationship, and a commitment to stepping out of my comfort zone, it really just took off. By 2006, I was making more money in a month than I'd ever made in a year in my corporate job. Robert and I launched a real estate development company, and we're still in that business to this day. Nearly every business we had, the seminar company, the mortgage company, the brokerage company, the investment company, were all over $1 million a year, and we own property coast to coast in 4 countries. It was amazing, right until it wasn't. Because when the great financial crisis hit, I was completely unaware that it was coming, and I was completely unprepared. The service that Peak Prosperity and people like that do in waking people up to what's going on and then intellectually explaining to them the logic behind it, and then helping them through all of what you have to do to prepare. And it isn't just financial. I love the 8 forms of capital: the social capital, the emotional capital, the knowledge capital. All of those things are so very, very important. I didn't have any of that. I just had a lot of money, and I thought, and really all I had was a lot of net worth, and I really didn't have true riches. I thought I was rich, but I was poor, and I was really never rich. And that's the thing. Even though I'd turn in my financials to the bank, and they'd give me these multi-million-dollar loans on apartment buildings and projects and whatnot, and my net worth was, technically made me a multimillionaire, but in reality, I was poor, because what I didn't have was resilient wealth. And when the crap hit the fan in 2008, the air came out of my personal bubble, and I was completely devastated. And I'll spare you all the gory details, but it was bad. And it was so bad, it really intensified my desire to study, to get in rooms full of the right people. And once I quit blaming, I went through a progression of learning. And, I'm here to tell you that I'm smarter today than I was, and I'm smart enough to know I'm not that smart. And that was probably the greatest lesson. So one of the lessons I got from the recession is the market isn't good or bad, you are. I'm going to say that again. The market isn't good or bad, you are. And so investing in your education, which you're doing, congratulations. I'm preaching to the choir, I know. But if you invest in your education, that's the best investment you could make. Next best investment is investing in your social club, being around a lot of smart people. But the key is that the market isn't good or bad, you are. And if you're a good sailor, you can navigate choppy seas. Okay? Net worth is not wealth. Cash flow is. When you have cash flow, you have real wealth, resilient wealth. If all you have is asset values on a balance sheet where assets exceed liabilities, you have paper wealth, you have faux wealth. I'm going to make that case a little bit further in a moment, because a lot of people use real estate to build net worth. Net worth is a byproduct, not a target. And it's a function of income, not a replacement for it. I wish our politicians understood that, but I'm not political, because they're not asking me my opinion anyway. But I think that you do have to look at what's going on and understand that the way they think and what they believe affects the things they do, and the things they do affects the environment you're investing in. So even though you disagree with them, you have to listen to them. And rather than argue against their position, because they're not listening to you anyway, just try to figure out what you need to do to react to what they're going to do, as stupid as it is, because there's nothing you can do about it anyway. So, and I already mentioned that smart people, I found out, listen to smart people. And so I needed to stop being the smartest guy in the room. I started to need to be the dumbest guy in the room. And then I needed to ask a lot more questions than I answered. And today I do that. And I'm always trying to get in a better room. And I'm going to share with you some of the rooms I get a chance to be in a moment. I'm pleased with those rooms. And Robert and I do our very best to share those rooms with people every opportunity we get. So we're both trying to improve them and also to share them. So the other thing I learned is that it's not the vehicle. Some people came out of 2008 and they threw real estate in the trash can. And I get it. There's people right now who could say, yeah, Russ, you could say the same thing about the stock market. I totally get it. I just decided that, I didn't want to dedicate myself to trying to master the stock market. I felt like there were too many things out of my control. I felt like there were too many really, really high-skilled big players involved that could outmaneuver me. And I just felt like I was way in over my head. Real estate to me was a lot simpler. I think that's one of the advantages, and we're going to talk about that here in a moment as well. But the key is it wasn't real estate's fault I lost everything in 2008. It was mine, because like a car, safety is largely in the hands of the operator. Definitely there's dangers out there on the road, but bad drivers have a disproportionate number of accidents, and good drivers somehow manage to navigate bad weather. And so what I discovered is highly successful real estate investors who thrived through 2008. So my failure wasn't the market, it wasn't real estate, it was how I was operating the vehicle. And so in spite of 2008, and largely because of 2008, I'm an even bigger believer in the role of real estate in a resilient real asset portfolio, as long as it's structured properly. And that's the key. And so that's the thing I really spend my time on, is making sure right market, right product type, right price point, right structure, right tenant base. Those are the things to focus on. I don't get mired in how to fill out a contract or, to calculate whatever. I have people who help do that. My focus is just on making sure I get those macro things right. So this is some of the smart people I get to hang around with because of what I do. Left to right real quick. G. Edward Griffin there, the gentleman with the beard, wrote the book, The Creature from Jekyll Island, which I'm going to talk about in a moment. Of course, Adam and Chris. Guy in the middle there with the beard is Peter Schiff. Peter and Robert Kiyosaki were the two loudest voices warning the world about 2008 and being laughed at because of it. But they were right. And so we started hanging out with them. The guy next to him is the mysterious Simon Black from Sovereign Man. He's one of the most impressive young entrepreneurs and investors that I know. Excuse me. Of course, that's me there next to Robert Helms. And so we get together with these guys on a regular basis, and we study together, we teach together, we pick up the phone and talk to each other when things are going on. And I listen, because they're all very, very smart. And so that's part of my social capital. And I encourage you to build as much of that as you can yourself. These are two guys who are some of the most successful, resilient wealth builders I know, and real estate's their vehicle of choice. You can probably recognize Robert Kiyosaki there on the left. He wrote the world's best-selling personal financial book, Rich Dad, Poor Dad. If you haven't read it, you probably should. In that book, he tells you that your house is not an asset. He talks about the importance of cash flow. He spends a lot of time trying to transform your thinking before he worries about trying to teach you how to do anything. He understands that how you think is far more important than trying to teach you the technical aspects of things that there are 1,000 people out there who can help you with. On his right is Kenny McElroy. Kenny has a portfolio of about 10,000 doors. And he and Robert not only survived 2008, but they thrived. They made hundreds of millions of dollars while I was losing money. So clearly it wasn't the market. They were doing something different. And what they did is they were building resilient wealth in real estate. I was building net worth with real estate. Very, very different things. So this is a big collection of people. Adam mentioned at the top, and I think Chris did too, our annual investor summit at Seeds, where we get a couple hundred investors together with a big bunch of thought leaders and brainiacs, and we hang out together for a week. We talk about what's going on in the world. We find out what other people are doing and thinking. We get a chance to have meaningful conversations and build meaningful relationships. And we've done it every year now for 16 years. Our 17th one is coming up in March of 2019. So it's a ton of fun, and I encourage you, through whatever means possible, through us or anybody else, find a way to get in rooms like this, and it will go much better for you. You'll be much better aware, much better prepared, and much more plugged into opportunities and all the things you need to actually implement the things that you learn. Because education is interesting, but our motto at the Real Estate Guys is education for effective action. Because if you don't act on what you know, it's really cool at a cocktail party. You get to hang out and pontificate, but if you want to change your life, you actually have to get out there and take action. And it means you have to take some risk too. So risk mitigation is a big, big part of what you're doing. And we're going to talk quite a bit about some of the risks that are out there. Because if you think about it, if you look at your investments are floating in a very dynamic environment. It's an ecosystem. An economy is an ecosystem, and it's very fluid. and there's storms and there's waves and there's wind and there are predators, and the metaphor is extremely apropos. And so is the idea of being a skilled mariner. And I'm really happy, actually, that I had such difficult times. And when I talk to people and I talk to them, the first thing I want to know from them is the difficult times they went through, because I know that's where the best lessons are. So there's an old saying, I think it was FDR, that said, smooth waters don't make a skilled sailor. So the point is, you learn by going through those hard times. So anyway, thanks for indulging me with all of that table setting. Give you a little bit of background on me, where I come from, what I think about, why I think what I do. Some of the lessons that I've learned aren't just rooted in, I read them in a book somewhere, but I lived them, and I paid a big price for the education. I'm hoping to impart that to you for a fraction of what it cost me. Of course, I mean, I did some things right too. But you know, I don't really talk about it. In fact, it's really interesting. I had an opportunity to interview Donald Trump before he was president or presidential candidate, and only got a chance to ask him one question because it was kind of a crowded room. But I asked him, I said, Mr. Trump, you know, you've made it big, art of the deal, and you lost it all and came back, art of the comeback. What did you learn in the good times? And what did you learn in the bad times? And my follow-up question is, you know, how would that help you become a good president if you win? He didn't answer the last question, but he said to me, he goes, you know, in the good times, really didn't learn anything. In the bad times, I learned it's always good to have a little cash. But the point there is that the lesson came from the bad times. So I've learned to love bad times. I don't seek them out, but I also don't resent them when they come. I realize it's part of the process. We've all had them. I'm sure I'm, again, preaching to the choir, but you know, one of the best ways to learn is to recognize and look at what's going wrong in the world and wrong in your life. And what Jim Collins in Good to Great would say, confront the brutal facts, and then take what you learn and figure out how to do better next time. So one of the things that I discovered coming out of 1987, and so I'm backtracking a little bit on my evolution. 1987, I watched my dad get wiped out, as I mentioned, in the 1987, October crash. And I wanted to understand why. And so in the course of trying to find that, I discovered this book written by a man named G. Edward Griffin. And it's called The Creature from Jekyll Island. I'm sure many of you are familiar. I think Chris and Adam have had them on the show. And in that, he describes what he calls the Mandrake mechanism. And Mandrake, the magician, could conjure money out of thin air. And that's what they do. The technical way it's done actually is currencies borrowed into existence. But if you think about that, that means that when you borrow whatever amount of money is in the system, let's say that we have a little economy and it's Russ, Robert, Chris, and Adam, and we all decide to start the game like a Monopoly game, but instead of them handing us $1,500 to seed the game, they loan us $1,500 each to seed the game. So now we've got $6,000 between all of us. And let's say we have to pay that back at the end of the year with 10% interest. Well, we buy and sell and trade, whatever. At the end, I have maybe a little bit more, and Chris has a little bit more, and Robert and Adam, well, they didn't do so good, or however it works out. But it all totals up to the 6,000 that was in the economy. Now, if we wanted to pay off our debt, we are going to have to come up with $600 out of the 6,000. Which means that the economy has to shrink. The only way to have the economy grow in a debt-based model where interest is due is to borrow more principal into existence. And so you have a never-ending spiral of debt. It just never stops. And so many people don't understand that. They're running around campaigning to get out of debt in the system. And the problem is, if we were in fact to get out of debt, it would extinguish all the money and we would have no medium of exchange, because that's the system. It would be like trying to dry out your aquarium. If you're a fish and you're in an aquarium and all of a sudden you become averse to water and you want to dry out, if you get all the water out of the aquarium, you're going to die. That's what would happen to our economy in this system. So until the system changes, you have to understand it's debt-based. And what that means, of course, is that the currency supply must continually grow, which means that the debt must continually grow. So economic activity to service that debt must continually grow. And the piece of the puzzle that I learned from Chris and Adam that's been so helpful, especially as a strategic real estate investor, is that resource and energy consumption must grow to feed that economic activity. It has to happen. And of course, the obvious challenge, as Chris and Adam point out, is that when the irresistible force of exponential debt runs into the immovable object of finite resources, there's going to be a train wreck. But until that happens, and it's a slow motion train wreck, I think Chris just did a blog on that recently, something along those lines, and I totally agree, is that there's going to be some things happening. And one of the things that's going to happen is the rise of what I call the three-headed dragon. A lot of people talk about rising prices. The Fed talks about rising prices. Most everybody calls it inflation. They just put it all in a blender and call it inflation. But there's really three parts to rising prices. And I think it's really important as a strategic investor of any kind, but especially a strategic real estate investor, to understand what those three are. They're demand, financing, and inflation. So with supply and demand, the way it works is as these finite resources deplete and the demand for them and the number of people in the world demanding them increase, there is going to be more people bidding up the prices of those items. That's not inflation. That's a reprioritization of purchasing power from other things into the thing that they need the most. And so in a zero-sum game, and I'm not saying we're in a zero-sum game, but that's a component of it, supply and demand takes the item that is in high demand and low supply, and it sucks up a disproportionate amount of available capital to bid it up. And so when you understand that, then you understand what the movement of money could be. But here's another thing. When you think about the things that get made, like properties that contain steel and concrete and copper and all kinds of commodities and lumber, all that stuff, when the prices of those finite resources begin to go up, anything that already exists in a marketplace that was built with those finite resources is by definition worth more in terms of dollars. Because in order for new construction to come online, the existing inventory has to be selling above construction cost. Otherwise, the marketplace is only going to buy the used inventory before it will fund the building of new inventory. And of course, the longer they don't fund the building of new inventory, which is kind of like what I call a production gap, then what you've got is you've got a constant growth of population and demand against this gap. And that's exactly what we had coming out of 2008. Housing prices dropped below replacement costs. Builders couldn't build. We were still forming, 1 million households a year or whatever it was in the United States, but we weren't building enough homes. We looked at that and we said, well, it's pretty obvious at some point in the future, all the homes that are selling below replacement cost are going to have to price above replacement cost, and there's going to be a housing shortage. And of course, if you've been reading, the news and listening to Lawrence Yun, the chief economist for National Association of Realtors the last year or two, he's been decrying the problem of not enough inventory. And so as a real estate investor, the economics of supply and demand matter. Commodities matter. And Kenny McElroy taught us coming out of 2008 that when many manufacturing jobs were gone and when a lot of the services jobs were gone because of the recession, it was just a train wreck, the one sector that kept things going was energy. Because energy is always needed to fund economic activity. And so he invested strategically in places like Texas. We went into Dallas, Texas in 2008 because we looked at the 4 major markets in Texas, believing Texas was going to be a great beneficiary of this energy need and boom. And we ended up going into Dallas because we felt it had the most diverse economy. There were some other things involved in why we chose Dallas of the 4, but it turned out to be the hottest real estate market of the next 10 years. And people were like, oh, guys, you were so lucky. Well, we weren't that lucky. We were well advised because we were listening to smart people. We were studying from all the lessons that we'd learned from the recession. And we were playing the game at a completely different level. We were no longer just, signing any loan we could get our hands on, buying any property that anybody would throw money at. And if it negative cash flowed or barely cash flowed, subsidizing it, thinking we'd make it up somewhere down the road. We didn't play the game that way anymore. Much, much smarter. So anyway, supply and demand is a dynamic that's out there. That's one of the 3 that causes rising prices. When demand is higher than supply, you're going to get a shift of money from other things, which are going to be losers. And that's another thing to think about, into things that are going to be winners. And even though commodities have been a little suppressed of late, and Chris and Adam may have some opinion on this, I think the next 10 or 20 years, it's going to be a little bit different story. Financing. Financing basically pulls future purchasing power into the present. It's how the banks and the politicians answer the problem of rising prices. So when things get too expensive for the rank and file people, to stop the pitchforks and whatnot from coming out and people rioting in the streets, they finance them. So it's why housing and cars and college all got subsidized by the government and didn't get cheaper. They got more expensive because the government doesn't understand basic economics. When you pull more purchasing power into the present from the future, you create two problems. One is you bid up the price of things because now people can pay more. And so it ends up getting more unaffordable. And then the next thing you do is you set off a debt bomb because you kick the can down the road because you keep creating all this debt, pulling money from the future into the present, and you create all kinds of equity in the present, but at the cost of the future. So we have been cannibalizing the future for many, 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 many years. And so when you look at all that debt going on, we're all watching the debt bomb, trying to figure out, how it's going to manifest, when it's going to manifest. One of the things that's been pretty obvious about the proliferation of debt and being in a debt-based system is inflation. The flip side of inflation is loss of purchasing power. This is a 105-year chart of the US dollar, and I think the trend line is pretty clear. And so if you just understand that you may get little blips of a temporary dollar strength or currency strength relative to other currencies, but ultimately these currencies are losing value in terms of being able to go out and purchase things that are real: food, energy, clothing, shelter, whatever, which means conversely, the dollar denominated value of those things go up. And so owning things that are real become hedges against this inflation. And again, I understand this is economics 101 for most of you, but for anybody that isn't on board with this concept, you've got to understand what is happening, where inflation comes from, and then how to make it work for you, because you can't escape it. So the only thing you can do, in fact, it was funny because we had Ed Griffin and Robert Kiyosaki on the 2012 Summit at Sea. And Ed got up and talked all about the Fed and the problem with the currency and debt and all that stuff. And then Robert got up and said, I don't worry about trying to change the government. I don't worry about trying to change the system. I'm not going to fight the Fed. I'm going to be the Fed. And that was his whole theme: be the Fed. And real estate investing lets you be the Fed because you can use debt to create assets on your balance sheet and then end up having other people pay for them and benefit from the inflation that is almost certain to occur in a system. So just that statement alone, if you really were to delve into it, tells you the power of real estate. If there's any doubt about the Fed's commitment to inflation, they post it right on their website, which you can go look up yourself, and they target and they publicly talk about all the time their goal of devaluing or making everybody savers poorer by at least 2% a year. And of course, they throw out some of the measurements that actually reflect a higher actual, real world rate of inflation. If you follow John Williams at Shadow Stats, you're probably familiar with that. If not, you should probably check it out. But the point is, people live in the real world. They don't live in this little basket of index that they use for the CPI index. And so in the real world, inflation is a lot worse for people. Especially people that live paycheck to paycheck and don't have assets, don't have things that are real on their balance sheet. In fact, when you put the three-headed dragon, the three components into a blender and look at what's going on and put all of this into a blender and hit puree, what you really find out is this system creates tremendous wealth inequality because the haves get to create more wealth and the have-nots end up having to spend more and more and more of their productivity to both pay the debt service and to service the inflation, not to mention, taxes. And even though we recently had a little bit of a tax increase, taxes are, a huge bite out of most people's check. So, that's kind of the root of what's going on in the financial system. Again, Adam and Chris do a great job of talking about this, and many of you are very familiar with it. But I think it's important contextually to have that table setting. And the key is to understand that money moves people. People will move to get away from oppression. So if right now you're reading about how New York and Illinois and California and other high tax states are hemorrhaging people because of the new tax law. They were hemorrhaging people before for this reason, but it got even worse when the SALT thing happened, when state and local taxes could no longer be deducted from the federal your federal liability. Now you're really bearing the full weight of the state you live in, and you're not asking the people who live in other states to subsidize it by giving you a break off your federal returns. But it's more than that. Illinois right now has a big pension problem. They have a hugely underfunded pension problem. They have the highest property taxes in the country. And they floated this idea. In fact, they actually came from a Federal Reserve governor, floated the idea of raising property taxes to close the gap in their pension fund to like 4%. And so, as a real estate investor, you have to take that into consideration when you're picking a market. You don't want to move into a market like that. That's a market that could create a lot of problems for you. Regulations. When there's a lot of regulations, there are certain areas, whether it's rent control or barriers to starting businesses and creating jobs. I could go on and on. Boeing threatened to leave Washington when the state of Washington came in and threatened some onerous regulations that they had to back off on. Amazon has picked someplace else to be other than Washington. So these companies, Apple Computer just decided to open their big headquarters in Texas and not California. So these things are what companies do. They move to escape these things. Conversely, people will gravitate towards low tax, business friendly environments, create jobs there. People will come there seeking those jobs and a more affordable lifestyle. So the markets that we have been most interested in over the last 10 years, in spite of the recent economic boom, and let me just talk about the economic boom for a minute, okay? If you have a big enough credit card, you can have faux prosperity. If you have a big credit line, you can have the nice car, you can take the fancy vacations, you can eat out, you can have the nice clothes, you can send your kids to great schools, you can do all those things and just keep kicking the can down the road. So you can have great economic activity, but your personal financial system is in trouble. So one of the things that I've learned in studying with all these smart guys is there is a big difference between the financial system and the economy. So when you hear, oh, the economy is strong, that could be true in terms of economic activity, but the financial system it all rests on is extremely fragile. And I'm going to talk about the reasons why in a moment. But the point is that if you are picking markets and property types and price points and catering to demographics that are going to be moving, and you anticipate the move properly, you will be able to put yourself in the path of progress. And even though some markets will lose as things get more difficult, other markets will actually win. And this is a big, big thing that goes to the argument that I have all the time that Adam alluded to at the top of the webinar, and that is that real estate's not an asset class. I mean, it's just not, because every house is different. And there's more than houses. There's commercial properties, there's mobile homes, there's farmland, there's resort property, there's hospitals, medical buildings, industrial parks, theaters, all different types of specialty retail. I mean, the list goes on and on and on. And that's just product type. Then you've got geographies. Washington, New York, and Chicago and Seattle are all kind of a market. Memphis and Kansas City and St. Louis and Indianapolis, those are different markets. They behave differently. There's a big difference between Central Florida and downtown LA. So markets are very different, and inside those markets are all those different types of product types. And there's demographics, because certain properties service certain demographics. And so, it goes on and on. The point is that if you were to go buy an ounce of gold, pretty much an ounce of gold anywhere in the world is an ounce of gold anywhere in the world, and it costs about the same anywhere in the world, depending on what currency you decide to buy it in. Ditto for a barrel of oil, ditto for a barrel of wheat, ditto for a share of Apple stock. These things are all commodities. They're largely interchangeable, and they're traded on exchanges that are hyper visible, hyperactive, and hyper efficient. Because of that, there is no art of the deal. You don't go in and have a negotiation. I think one of the things people don't understand with Donald Trump, love him or hate him, he's a real estate guy. And he understands everything's negotiable. And so he negotiates everything. That's the way he thinks. That's his paradigm. People that have come out of Wall Street or deal in commodities and deal in paper assets, they think in terms of trends and technical markers, and they deal in bulk. They don't deal personally. They don't sit down one-on-one and understand what's going on. Even two houses built by the same builder at the same time in the same neighborhood on the same street are completely different deals, because one could have a lot of improvements. One could have a problem ownership that somebody's desperate to get out of. Somebody else has a lot of equity and they would be willing to carry back, and you can negotiate seller financing. I mean, I could go on and on with that. So the point is that real estate is hyper inefficient. And once you master the art of playing the game, which is not all that difficult, the inefficiencies are actually a blessing, because you can make money on the buy. That is really hard to do. I mean, you hear stories all the time about guys like Warren Buffett, and they do value investing, and they're really good finding things that other people miss, because they can dig into the bowels of a financial statement better than anybody. And they have enough clout to go in there and maybe create management shifts or maybe create synergy between different businesses. But for a mom and pop investor, are you kidding me? There's nothing you can do. It's a completely different level. So real estate is not an asset class. It's hyper inefficient, which is great. And it really is about the art of the deal and knowing how to put the deals together. And so in order to do that and invest in real estate strategically, it's really important to see the bigger picture. This is what I was missing coming into 2008. I could go look at a property, I could look at its condition, I could read the appraisal, I could read the inspection report, I could do a quick little pro forma on income and what my CapEx was going to be, calculate my ROI, calculate my projected rent increases and my projected equity growth, maybe anticipate if interest rates came down, I'd get a little bump there, right? I could do all that. What I didn't see was what was going on, over the horizon. I didn't see the buildup of derivatives in the mortgage-backed securities market, which are like ticking time bombs. I didn't see the proliferation of debt. I didn't understand counterparty risk. Never even heard the word. I didn't even know what it meant. There's so many things that I didn't understand. Of course, when all those things started to manifest, I wasn't sharp enough to recognize the clues. I wasn't plugged in enough to talk to people who were. And even if when I did talk to people, I wasn't smart enough to listen. I only was smart enough to be smart about what I knew instead of putting new ideas in my head. And the point is that future is coming very, very fast. And when you realize that the future is coming fast, then you need to step your game up, I think, in terms of preparation. Again, preaching to the choir, right? You're on the webinar, and that's fabulous because you're the right kind of people. I hope that when you come off this thing, if you find value, you go tell 10 people and get them to watch this one and become part of the series, because this is information, as Chris and Adam always talk about, information that you need to have. I can't remember exactly what their tagline is, but it's information you need to have. They always say that you can't afford to live without, right? I'd like to believe this is information you can't afford to live without. And that's because we live in a world of out of control debt. I mean, you don't have to be a rocket scientist to understand that. It's not that complicated. It's all around you. But I'm just going to hit the high notes real quick. This is a chart that shows U.S. total household debt. I just pulled it down yesterday, so it's fairly recent, all-time high. This is a chart from the St. Louis Fed, shows corporate debt, all-time high. This is a chart that shows the U.S. public debt. This is what your government does on your behalf. Even if you decide to live debt-free, they're going to go get in debt for you. They're in debt for your children and your children's children and your great-great-great-great-grandchildren who haven't even been born yet. They're all in debt because of this. And this, of course, as you probably well know, is only the debt they acknowledge. It's not unfunded liabilities and off-balance sheet. The real number is a whole lot worse. U.S. public debt per capita, all-time high. Okay, so debt is clearly out there. And there are people who say the debt doesn't matter, but it kind of does. And even though the amount of debt isn't the problem, as anybody who's got a credit line can tell you, what really matters is your ability to service it. And so there's a couple things that have been going on for a long time. ever since the reset, because we defaulted on the gold standard in 1971, the dollar collapsed. And as a result of that, we cut a deal with the Saudis in order to suck up a lot of the excess dollars into the oil float and trade, and that worked. And then we jacked up interest rate. Oh, the other thing, we went and opened up trade relations with China so that we could bring our labor costs down to try to control inflation. We augmented that with the American consumer ultimately by teaching them how to go into debt so they could have a faux lifestyle instead of a real lifestyle based on earnings, because all the jobs went overseas to suck up the inflation. And then, of course, the other thing we did was we had to reset the strength of the dollar. And so Volcker jacked up interest rates to 21% in the early 80s. And then it was on a 40-year slide with a few blips up and down. And then, as you can see, it flatlined for about 10 years after the financial crisis. And it really wasn't until the prospect of lower taxes came and the idea of going further into government debt gave them a little bit of breathing room to try to raise rates. And so, just think about, I mean, again, maybe this is too basic, and I'm sorry, I apologize if you already got your mind around this, but for the few people out there who don't really track with this, it's very simple. Just imagine that, in your household budget, you can afford $200 a month of debt service, and that's what you can afford because of your fixed income or whatever. And you have a $10,000 credit card, and let's say it's at 24%, and you can debt service at $200. Credit card company needs you to go further into debt because that's how they grow their business. And so they decide to double your credit line and put your interest rate in half. Okay, so they're going to end up getting maybe the same amount of interest, but they're going to be able to create more fees. All right, however, whatever their motivation is. The point is, your $200 is now debt servicing $20,000 at half the rate, and then they come back and do it again, and now you drop down from 24% to 12%, and you go from 20 to 40. You see what I'm saying? So pretty soon, you've got $100,000 of debt and next to no interest you're servicing for $200 a month, which makes you very vulnerable to an increase in rates. And at some point, the lenders can only go so low before they just can't do it anymore. And that's why you've seen, talks about negative interest rates. There's almost $9 trillion of negative interest rate bonds around the world. So there's a lot of this stuff going on that is all just reflected in looking at interest rates and trying to interpret what's going on and how that relates back to the debt. So all of this debt being created has filled the world up with something called counterparty risk. And I don't care what you are investing in or how you invest, I encourage you to pay close attention to your exposure to counterparty risk. Okay, because most investors I've talked to don't even really understand it, and they're very naive about where it exists in their own life, and certainly where it exists in the financial system that they really depend on. So the basic concept of counterparty risk is when your asset, something that you have on the positive side of your ledger and your balance sheet, is simultaneously someone else's liability. Now you're exposed to counterparty risk because if that counterparty fails to perform, your asset has no value. This is what happened in 2008 as the subprime market started to devolve because the subprime borrowers were getting their 2-year reset on those 228 loans, couldn't afford to make the big jump in the payment. They couldn't afford to refinance because the market had shifted a little bit. And they started defaulting. Normally, that's not a problem. Ben Bernanke famously came out in 2009 and said, hey, it's contained. But what he didn't understand or didn't want to acknowledge is that the derivative market underneath had taken that one real asset, because a mortgage is a real asset, by the way. A mortgage, some people think a mortgage is a derivative, but it's really not, because what you're going to get when you loan somebody money, you're either going to get the income or you're going to get the property. And so it's directly back. So yes, it's a derivative, it's a claim on wealth, but it's a claim on wealth where there is no counterparty on the property. The property is there. There is no person. If the mortgage defaults, you get the property. And if the person defaults, if the person pays, then you get the income. So everybody looked at that on Wall Street and says, oh, wow, this is super safe. And the Clinton administration and the then Contract with America Congress with Newt Gingrich, the first Republican Congress in 40 years, they kind of balanced the budget in the late 90s. And so government wasn't issuing that much debt. And then we had the big corporate America scandal with Enron and Arthur Andersen. And so investors were skittish about corporate debt. And so Wall Street, wanting to place people who wanted to purchase income, concocted mortgage-backed securities and looked at the track record of real estate and the safety of mortgages and sold it silly. Well, the problem is when they'd made every mortgage they could possibly make, they needed to do more mortgages. So they created derivatives. And a derivative is a thing that reflects the real thing, but it isn't the real thing. And so they created a derivative, and they created a derivative of a derivative of a derivative. And if you read Bethany McLean, All the Devils Are Here, I mean, she says it went like 70 layers deep. When Joe Sixpack, getting up every day to go to work with his little, lunch bucket, defaulted on his subprime loan, it didn't just create a problem for one person, it created a whole chain reaction of problems for everybody that was in this chain. And so the counterparty of that one borrower infected the entire system. As those debts were going bad, and with a mark-to-market system, these guys were having to adjust their balance sheet to what was going on. They had now margin calls, and I'm going to talk about margin debt in a minute. So they had these margin calls. So now they had to sell whatever they had available. And of course, the garbage wouldn't sell. So you had the garbage just falling through the bottom, which created more margin calls. And then the good stuff had to go to fire sale, and all the air started coming out of the jump house. And in a system that is debt-based, where there is collateral everywhere and counterparty risk everywhere, it doesn't take much of a spark to start a wildfire that just implodes the whole thing. And if you're not aware of that, keenly aware of it, and paying attention and structuring yourself to withstand it, you are so far more exposed than I think you realize. And so again, maybe I'm preaching to the choir, maybe you already know, but if there's just one person who's watching this who didn't know that, who goes and looks at their situation and fixes it, then I'm going to say it was worth the time. So thank you for indulging me on that. So here's some places to look for some counterparty risks that you may not be aware of. Via bank deposits in excess of FDIC insurance, you could be exposed to counterparty risk. If you have annuity contracts that you're counting on for payments, you could be exposed to some counterparty risk. If you have brokerage accounts where you don't hold your securities in your own hands, but you're just depending upon your statement from your broker and they're holding them in custody for you, if you will, or in trust for you, you could have some counterparty risk. Really, anytime any third party is holding an asset on your behalf, if they fail to uphold their end of the deal, you have counterparty risk. So just be very, very aware of that. In business, they call doing a SWOT. Many of you are business people and you know a strengths, weaknesses, opportunities, and threats analysis. You should learn to do that on your portfolio. I never did that. I never even heard of that, right? I'm in business. I had all this stuff going on. If I would have done a threat analysis on my business, I would have recognized, or weakness and threat analysis, I would have recognized that I was brokering debt with my mortgage company. I was running all my cash flow needs on credit lines, not on cash and float. I had next to no cash in the bank. I was more than fully deployed. I was highly confident in my good credit and my credit lines. I had properties that were overly leveraged, and every time I had equity, I used it as a down payment on another property at next to no positive cash flow. And so I needed a healthy market with financing to sell those properties if I got into trouble, which I always thought I could, or the things we were building, we needed buyers, we needed construction financing to build them, and we needed takeout financing to sell it to the open market and get our profit. Obviously, the one common denominator in all of that, if I would have an ounce of common sense, is that I was completely exposed to the credit markets. And if the credit market ceased for any reason, which they did, and for any length of time, which they did, I was going to be completely out of oxygen. And no matter how big and great it was going to be on the comeback, I was going to die. And that's pretty much what happened. And so counterparty risk is a big risk that's out there right now that real estate investing can help you mitigate largely. And I'll cover that in a moment, but one you really, really need to understand. So in summary, in this part of it, kind of the table setting part of investors face some big challenges. You've got the dollar falling, we've talked about. You've got interest rates that have been flatlined, which create malinvestment and a whole host of issues, even though they've come up a little bit. The odds are they're coming back down. And even if they do stay where they're at, they're certainly far from anything anybody would call normal. And so it creates problems. You know, when you can buy an asset that cash flows 1% because you can buy it at 0.5%, it seems to make sense. But if interest rates move to 2, now you've got a problem. There's a lot of that out there in the market right now, too. So the system is fragile, as we talked about. I touched on pensions and entitlements, didn't have time to dig into that, but that's a big bomb out there ticking. Talked about growing debt, counterparty risk, I spent some time on. And didn't spend any time on loss of privacy, but that's a big one too. One of the things that I love best about real estate, especially international real estate investing, is if you use the right entity structures and jurisdictions, you can create a high level of personal privacy for the bulk of your wealth. And so I don't have time to get into how to do that here. In future sessions, I will. But I want you to know that even though you think, oh, my property's just hanging out there in the wind with my name on it, a publicly recorded deed, how do I hide my wealth? Trust me, there are ways to do it. And we'll cover that in future sessions. So to kind of figure out how to deal with these issues, we got to break a few paradigms. You know, when Morpheus handed Neo the red pill, and he was going to wake up from his illusion and see things as they were. So I already touched on the idea that net worth isn't real or resilient. And so, you know, the jump house kind of looks like this. You know, when asset values are based on a lot of debt being continually pumped into the system, it's like a jump house. Everybody jumps around in it. They have a lot of fun. But the problem is that when the big players get spooked and they all pay attention, they're like a long-tailed cat in a room full of rocking chairs. They all hit the sell button and the air comes out. And when those nervous investors rush for the exit, you know, that's where mom and pop investors get left holding the bag. So this is the NASDAQ composite. I went back to, you know, like, I don't know, 1970 something, I think 71, but it hit a high of 6,900 in February of 2000. Prior to that, it had been relatively steadily climbing, you know, with a few blips, but then whammo, right, in 2000, and it dropped hard. It made a little bit of a comeback and then bounced down to its bottoms in 2008. But in order to get back, if you had bought in at the height of the hype and ended up eating that loss, and Chris talks all the time about, you know, it's not a question of if, but when, who's going to eat the loss. It was 17 years before you got back to even, 17 years. And so if you would have been in your late 50s or 60s counting on your tech portfolio to pay for your retirement, you had a very small retirement or a delayed retirement. It was no fun. And so that happens to people. And the reason it happens is because of the way these things get valued. And they get valued with something I call comparative sampling. It's the way stocks get valued. It's the way houses get valued. And the way it works is that when one person sells, everybody who owns the same thing thinks that's their price. I'm going to illustrate it to you very simply with real estate. If you can imagine an economy where there's $1 million, that's all there is. The most there is in the entire economy of purchasing power is $1 million. And there's 10 houses that are 100% identical. I know I just said that's not an asset class, but just for sake of illustration, let's just say they're exactly identical. So you would assume that each house is about worth $100,000 because 1 million divided by the 10 is $100,000. Okay. And again, very simple. There's nothing else competing for the money. There's no financing from the future. This is just a very simple model, but it gives you the explanation. Now, one day, somebody living in one of the houses decides to put their home up for sale. And inside this economy, this $1 million economy, people are doing business, buying and trading. And, you know, a very successful guy has accumulated $200,000. And so he really wants this house. And so he buys it for $200,000. And certainly with $1 million in the economy, it could sell for $200,000 quite easily. And so it does. Well, what happens is, based on the comparative method of appraisal, which is how houses and stocks are valued, every person holding a house on their financial statement now thinks their house is also worth $200,000. And so if you just do simple math, you realize that those 10 houses now valued at $200,000 are worth $2 million. So now our economy is $2 million. But is there $200 million in the economy? And the answer is no, there's not. And so if everybody decided to cash out because of some panic, all of a sudden houses became out of vogue, there would only be $1 million bidding. Those houses would all drop to about $100,000, and all of that fake air would come out of the valuation. The equity would disappear. And so what I say is, and this should keep you up at night, do you realize that unrealized gains aren't really real? Really? And so again, look at your personal financials and ask yourself, how much unrealized gains are you counting on for denominating your net worth? I'm going to argue that's probably not the best measurement of wealth. It certainly wasn't for me. Because what happens is when somebody does something stupid, like pick something that any one of these companies does. I think Wells Fargo just screwed up their website for a couple of days, or Facebook comes out and tells everybody that they actually lied about how many subscribers they have, or they've been selling information they haven't to teenagers, or whatever they do something stupid, everybody hits the sell button and the air comes out. And that's where you see headlines like this about America's lost trillions. Or on the flip side of it, you see a headline that looks like this, and it says households' net worth climbed by 2.3 trillion. Now, do you think that in an economy that's about 20 trillion, in one quarter, Americans saved 50% of their productivity? See, that's not savings. That's just air in the jump house. And so it's not real. And so if it's not real, it begs the question, well, what is? Full absorption. When everybody goes to sell, that's the price. So if you think about it, let's look at an apartment building. In an apartment building, maybe in an area that's doing decently well, you might have, say, 90%, maybe even higher, but let's say 90% of the apartments that are for rent, they're all rented, which is basically full absorption. So with 90% and full absorption, every month a tenant bids, if you will, on a place to sleep for that month, and every month a landlord accepts the bid. There's not going to be 500,000 new units all dumped on that market in a heartbeat. So when you derive value from income, and income is more stable, you have a better sense of what value is. And let me just show you a chart I pulled up from the St. Louis Fed showing real estate equity coming up to the 2000. You can clearly see where the bubble was from leading up to the dot-com bust, and then after it, and then the crash in 2008, and then it's popped back up. So that's what happened to the equity, which basically means this is what happened to the prices. But look what happened to the income. The income dipped a little bit, not for as long, and certainly not by as far. So the point is the income was far more stable or resilient. And so the key is real estate can provide you resiliency with your wealth if you denominate wealth in income, not in asset price. And if you go buy a property and you're going to hold it for 20 years, if it falls in value next week in half and it still pays you the same amount and you're going to hold it for 20 years, you don't care. Doesn't matter. If you look at your balance sheet and you're trained to look at your balance sheet, you freak out. But if you're looking at your income, you don't care. Ken McElroy and Robert Kiyosaki did not care that they lost millions or hundreds of millions or whatever the number was in net worth during the financial crisis, because their cash flow continued. In fact, what they did is they went out and bought more income because they could purchase streams of income on the cheap because the prices had dropped. And it really goes to this other notion, this adage that people think is, investing strategy 101. Everybody knows this. Gee, it's common sense. Doesn't everybody know the secret to getting wealthy is buy low, sell high? I disagree. I used to think that myself. I used to try to do that. That's why I day traded stocks. That's why I tried to flip properties. That's why I always thought that the round trip was cash to asset to cash. But buy low, sell high is a dead end. And that's because when you end the round trip, all you have is a pile of cash. Think about that. If you go from cash to asset to cash, then all you have is cash, not cash flow. All you have is cash. And cash has a 100-year legacy of falling in purchasing power. Then you might agree with Robert Kiyosaki, who says cash is trash. Here's the other thing about that buy low, sell high mentality. It feeds the three-headed snake. That's different than the three-headed dragon, okay? It wasn't easy to find a picture of a three-headed snake, let me tell you. So brokerage commissions, when you buy, you generate a commission for Wall Street. When you sell, you generate a commission for Wall Street. The more you do that, the more money they make. They can also front run you, but that's a different story. Okay? You create realized profits for Uncle Sam. If you trade, buy, sell, you create capital gains. And if you're doing it in less than a year, you're paying ordinary income tax rate. So you create tax for Uncle Sam, and you create float and piles of cash on deposit with the bank, which they lever up through fractional reserve banking and create double-digit returns for themselves on, where they pay you a fraction. Okay, so it's a good investment strategy, but not usually for a Main Street investor. So that's another thing to think about. So if that's not the deal, if that's not the path, then what is? Instead of cash to asset to cash, let me make the argument that you want to go from cash to asset to cash flow. And this is probably one of the biggest paradigms that I had to break in my own life to understand, because Kiyosaki, we wrote a book called Equity Happens. And that's because we understood inflation, we understood real estate was going to be a beneficiary, we even understood shorting the dollar. But the emphasis was about net worth. The emphasis was about creating equity. Equity is great, and you should, because it helps you create cash or equity that can be used to purchase more cash flow. But the emphasis has got to be on the cash flow, and you actually create equity through cash flow. I don't have time to explain that. We will in future sessions. But understand that cash flow is equity. They're not opposed. So we don't disagree with Robert Kiyosaki, but we feel like he tells the story much better. So he continues to publish his books. And our book, I think, is good. People like it, but we haven't republished it yet till we get a chance to update it a little bit with some of the lessons that we learned. But here's the key. What cash flow really is harnessing and leveraging the efforts of others. If you think about all of wealth building, resilient wealth, it is harnessing and leveraging the efforts of others in a win-win sustainable relationship. So you do that when you create a business and employ people. They get a job, and the dignity of being productive, will you make a reasonable profit on the efforts? And what's even better is it's stable, resilient, and a long-term relationship. And so that's stable. If you can build a company and you're smart enough to do that and you've got the chops, God bless you, do it. But real estate gives you the same thing, because it's not the property that's the asset. It's the tenant. The tenant gets up every day and goes to work for somebody else. They train them, they supervise them, they pay for their time off, they deal with their drama. You may have to deal with a little of their drama, but not as much. But the point is, they get up every day and go to work, and they pay you 25 to 30% of their gross pay in exchange for living and taking care of your property. That seems like a pretty good deal to me. So my question is, how many people do you want getting up every day and going to work for you in a long-term, sustainable win-win relationship? That's what harnessing the efforts of others is. That's what real estate gives you the opportunity to do. And it doesn't have to be an individual. It could be somebody, a business. It could be a small business that's thriving in a retail center. It could be a big distribution center where you got a credit tenant like an Amazon or somebody in there. Doesn't really matter. They aren't interested in what you're interested in. They make their money operating their business. They don't want to tie their capital up in the real estate. If you're willing to tie your capital up, and of course, it's not really your capital because a bunch of it is going to come from the bank, and if you decide to syndicate from your investors. But the point is that you're going to control the property, provide the property to the people that do the work, and they're going to pay you a fruit of their labor. And that's really the essence of real estate, resilient real estate investing, harnessing the efforts of others through long-term, sustainable win-win relationships. And real estate is arguably the easiest vehicle for an everyday person to pull that off, especially residential real estate, because it's so easy to understand. So I'm going to cover a couple of key points real quick.
Great. And hey, Russ, it's Adam. I'm sorry to interrupt at such an important point in the presentation, and you're doing such a great job. I'm just doing a little time check here. It's 10:30 right now. We told folks that we'd end up, or 10:30 Pacific. We told folks we'd end up in about 15 minutes. We can go a little bit over, but we definitely want to leave a little bit of time for Q&A. So just wanted to give you, a little bit of time check.
Okay.
I know you're getting near the end of the presentation anyways, but we've had some great questions here. We want to make sure that we give you a chance to field some of those too.
Okay. And I'm happy to stay as long as whatever. So we can ask the questions offline and, people can hit it up on the recording, but I will pick up the pace. Sorry. It's hard for me. I'm just staring into the camera, so I can't really read audience reaction here.
You're doing great.
Okay.
Thanks.
Appreciate it. Okay. So let me just bang through this real quick. So let me just make the case for real estate because I really felt like I put quite a bit of time into the underpinnings because you can't appreciate the things I'm about to share, I think, without that. And hopefully some of you could relate to some of that. Many of you lived through some of the events that I've talked about. This is real world. So real estate's versatile because you can get income from being an owner. Of course, that comes with responsibility. You can get income from being a lender. You can own mortgages. You can lend on real estate. And you don't have to deal with the equity risk. You don't have to deal with the ownership risk. You can just collect money. And that's fine. And the yield is a lot better than most bonds you're going to get. And a lot safer too. Real estate, real equity is based on income, as I just talked about. So you get that, and you can force equity too, but you also get the inflation equity. If just, if overall the economy inflates, wages go up and everything goes up, real estate is a beneficiary of that. So you don't have to be a rocket scientist to create equity long-term in a debt-based system with a failing currency. But this is one that a lot of people don't get. It's a deflation hedge. And I'm just going to explain quickly. I can prove it by the math later if anybody takes exception, but it's very simple. If you put $20,000 down on a $100,000 house, your $20,000 is what you have at risk. You get an $80,000 loan from the bank, and you put a tenant in there who's paying. I already showed you that when the prices fall, incomes don't fall as far as fast. Okay. And that's pretty typical because when incomes fall, there's a revolt. And so there's a lot of pressure at every level of society to keep incomes up as much as possible. So with that said, if you've conservatively structured it so that it cash flows and your debt servicing, you're $20,000 in. If the price of that property drops to $50,000 and never recovers in 30 years, at the end of 30 years, your $20,000 is now worth $50 because the house is paid off by the tenant. And the odds of deflation, I think, are much smaller. When people talk about inflation or deflation happening before inflation, they're talking about asset price deflation. And I totally agree. The difference is I totally don't care. I hope it happens because that's when I go shopping. Real estate provides tax shelters. Tom Wheelwright does a great job explaining that. We're just about to release a podcast on that very topic. In fact, real estate has become the best tax shelter out there right now, thanks to the new tax law. That's what happens when you put a real estate guy in charge. So you can literally create tax-free income using real estate. And that's why guys like Trump and Kushner and Kiyosaki, they don't pay income tax because they use real estate as a shelter. And it's an asset protection haven. I won't get into the details of that. Or an estate planning vehicle, but real estate is a great way to pass wealth from generation to generation and avoid really all the tax. You have to do it properly. And again, I'm not an attorney, so I'm not here to tell you that, but just be aware it can do all these things. Real estate really is a Swiss Army knife. Anything you can do with paper assets, I believe you can do better and safer with real estate. So real estate's strategic. You can capitalize on trends. You can capitalize on demographics, millennials, baby boomers. You can capitalize on geographies where jobs are going in. Look at people who all rush to front run Amazon going into Long Island. Not that I would trust that, and that may backfire on some folks, but certainly things like distribution hubs, where there's oil or great farmland or great mining resources. So you can pick geographies strategically that are likely to have viable economies even in a downturn. You can certainly capitalize on economics, changes in interest rates, where jobs are being created, rises in interest rates, things like that. Certainly things financially when interest rates drop. Industry specific. I mean, we got people that specialize in farmland. We got people that specialize in resort. We got people that specialize in self-storage, people that specialize in retail, industrial. The list goes on and on. When an industry gets hot, you can cater to that, and if you see it coming, you can be in front of it. And again, these things aren't hard to see because most of these rollouts happen slowly because real estate just moves slowly. So that's an advantage. You know, you don't have to be a high frequency trader to make it with real estate. Real estate's stable. It's essentially human existence. Think about it. You know, I don't think anybody's going to create a technology that's going to eliminate the need for people to live in houses or food to be grown in land. You know, they've tried some hydroponics. It didn't work out from a nutrition point of view so well. Even then, it was in a warehouse, so it's still real estate. It's a primary asset, like Chris and Adam talk about. It's illiquid. Some people think that's a negative. I think it's a positive. If you're in it for the long haul, and that's what they try to tell you, buy and hold for the long haul. And then why do you want liquidity? All liquidity is a roller coaster ride. If you're in it for the long haul, be in it for the long haul. Now, with it said, there's definitely ways to extract equity along the way and be liquid, and you should. And those are some financial strategies we'll cover in the future. It's very difficult to corner or manipulate. Very hard for the Wall Street players to get their minds around it and attack it. I mean, they're definitely involved now because it's so good, but still, it's very difficult to get hurt the way you can get hurt in the paper markets. The sharks have a much more difficult time navigating real estate. It's protected by the powers that be, the banks, the politicians, big industry. They all care about real estate. So they go to bat. And I think 2008, every time real estate has had difficulty, that's been proven by the way they've behaved. Real estate's resilient. It mitigates counterparty risk. Just think about this for a second. If you have a bond, which is an IOU, and the borrower defaults and the payments stop, what recourse do you have? Not much, right? If you have made a private mortgage to somebody and they held collateral against the property and they quit paying you, what recourse do you have? Well, you can take back the house. You say, well, I don't want to own the house. Okay, we'll take back the house, and or you could sell the house to somebody else and carry back the note and just create a new note with a new borrower. And every time they fail, you can just take back the collateral. If you get tired of doing that, then you could be the landlord, put a tenant in. You say, yeah, but the tenant, what if the tenant doesn't pay? You can evict them and put in a new tenant. If a bondholder doesn't pay, you don't get to evict them and put in a new bondholder. I mean, that alone is just ridiculous. Plus, the yields are better. So I don't understand people in the bonds, especially with interest rates where they are right now at all, unless they're trying to flip bonds, betting on the direction of interest rates. And again, that's just a buy low, sell high fallacy game, you know, that I certainly don't want to play. Income's based on full absorption. I covered that. Value based on income, not momentum. So nobody's looking at trend lines in real estate. They're just looking at income and maybe trends of income or what's going on in the local economy. Clearly, real estate outperforms in an inflationary environment, as I mentioned, hedges against deflation. It's leverageable. You can get financing. It's some of the best low-cost financing you can get. You can hold it for the long term, fixed rate. You don't have to worry about getting taken out. You don't have to worry about margin calls. Generally, it's readily available. Not always, but generally it is. And when it goes away, it comes back pretty quick. As I said, the powers that be have a lot of motivation to make that happen. I'll get into in future sessions the way leverage magnifies growth and return. That's probably the most misunderstood thing. Real estate debt is good debt, and it's all about arbitrage. If I can borrow money at 5% and invest at 8%, how much 5% money do I want to borrow? Pretty much all of it. And if I could use 4-to-1 leverage to take a 2% return and turn it into an 8% return conservatively, I probably want to do that. And so those are some of the things that leverage can do for you. And it makes it a lot easier to get started because real estate is a high ticket item, but when you get most of the money from the bank, you don't need that much money of your own. And you probably, even if you had it, wouldn't want to use it anyway because all of the benefits of leverage. And again, I already talked about no margin calls. Another thing I love about it is it leverages time. You get economies of scale. It takes me just as much time to do a $200,000 deal or a $2 million deal as it does a $200,000 deal, or incrementally more time for a $2 million deal. So the point is, you look at a guy like Donald Trump or Sam Zell that do these billion-dollar, hundreds of million-dollar deals. They're not working that much harder than the guy doing the little $2 or $3 million apartment building. They're just doing bigger deals and they get economies of scale. The other thing is when you go big, there's all kinds of help available. You don't have to know everything about doing this. You're in charge, so that is a little bit different than just turning your money over to somebody. But you don't have to get your hands dirty. Everybody can do the work. You just have to understand how to do it. And the good news about that is real estate's understandable. The business model is pretty simple. People live or work in your property and pay you rent. And it's pretty easy to figure out how to add value and increase the rent. So again, not rocket science. It's easy to understand the competition and where it's coming from. Easy to operate and hire help. Already covered that. It's easy to create value. If you buy a share of company stock, you can buy as many Apple computers or cups of Starbucks as you want. You are not going to move that stock price. But it is definitely possible through creative investment to create value in a real estate. You go put a $300 dishwasher in an apartment building, you get $25 a month more rent in 1 year. It's paid for itself, and every year after that, it's increased your cash flow. And so there's many things you can do to create value. Real estate helps build many forms of capital. This is probably my favorite, and maybe we can talk about this at another time, but Chris and Adam talk about the 8 forms of capital. Obviously, real estate helps you build financial capital, but it can also help you build living capital. You could go out and buy a farm. You could go out and buy a ranch. You could go out and acquire things that you would want to have as part of your living capital, but instead of paying to own them, you make them pay you to own them. And that's the advantage of going bigger, because you only need a small portion of it for your own needs, and then you have an abundance to sell to other people, or if you don't need to make the money, to carry some people over in a crunch. So it's great for that. Material capital, think about tools and equipment and supplies. If you buy all those and stick them in your garage for a rainy day, they're idle assets. If you have them as part of an active piece of real estate and they're generating value, you still own them, you still have access to them, but the property is paying for them, keeping them up and putting them to productive use if and until you ever need them yourself. Knowledge. I learned a lot by working side by side with the tradespeople in a rehab project. I learned how to sweat pipe, pull wire. I learned how to do finish carpentry, put in cabinets. I learned how to paint. I learned how to do all kinds of things. So if you choose, you're going to be around a lot of really, really smart people, tradespeople, practical skill people that you're going to be able to gain knowledge from while you're busy adding value to your property. So it's just one of many ways you can increase your knowledge capital by being involved in real estate. You learn a lot by investing in real estate. You go through ups and downs. You'll have to deal with greed and fear. You'll deal with setbacks. You'll deal with drama, just like in regular life, but you'll just deal with more, and the stakes will be a little bit higher. It'll make you stronger. So you can get this anywhere, of course, but you can certainly get it in real estate. Social capital is huge. Think about this. First of all, you've got your network of advisors. If you decide to syndicate, which is my favorite way to do it, you will have a network of high net worth people that have invested with you that you become friends with. Some of them could be doctors, lawyers, business owners of various types. You can also create opportunities where you rent to those people, medical office buildings, legal offices, factories. So you can create a lot of social capital just by strategically investing in either with or in support of or renting to people that you want to know, people you could barter with in a crisis. If the cash goes bad and somebody's living in your property, in lieu of rent, maybe they could perform some services for you, working on your car or whatever. So the list goes on and on. Cultural. You can take advantage of different geographies. You can invest in different ethnic groups if you chose to. You can do a lot of things to enhance your experience to culture and different cultures through your real estate investing. Again, everything can be funded financially, but don't just think of real estate as just a financial capital building tool. It is so much more than that. And of course, the ultimate is time. The biggest benefit of real estate done right is it creates multiple streams of passive income from different tenants, different properties, different geographies, different sectors, different countries, different currencies. And it comes in largely passively, which gives you all your time back. And on the way that you're building it, there's lots of time leverage in building it too. So, when I studied Prosper and I started considering what I was doing, and I looked at what Chris and Adam were proposing, I thought to myself, wow, this is amazing. Real estate's even better than I thought. So there you go. Future sessions, and then I'm going to close and we'll do the Q&A. And again, sorry, I was a little long-winded. I never know how long these things are going to go. My partner Robert's going to come in. He's going to teach you a simple 4-step process to start your real estate investing right. Most people do it backwards. We're going to teach you how to do it the other way. Property is the last thing you get. I'll probably delve in at some point to financial strategies for creating growth, income, preservation of wealth, privacy. I'll do math. I hope you're not averse to that, but I'll do the numbers for you. We'll talk about picking your niche, deciding where to start because you want to study a niche and get pretty good at, then building a team to help you do it right. And then how to combine your investing and your income generation into one activity so you can build wealth faster. And then we'll come up with other things based on what you tell us you're interested in. Lastly, we've got our podcast, which you can listen to every week for free if you haven't already heard too much of me. We do a weekly newsletter that comments on what's going on in the world from a real estate investor's perspective. We have a special reports library where a lot of our contributors have written content about a variety of topics, markets, niches, all kinds of different things. We do some live events. You have to pay to come to those. The Investor Summit at Sea, our annual conference on a cruise ship. This year got Chris and Adam coming, Robert Kiyosaki, G. Edward Griffin, Peter Schiff, whole bunch of niche experts that are experts in apartment investing, residential assisted living and resort property, self-storage, and list goes on and on and on. We have Investor Registry. That's a way to get in the deal flow. And we have a series called The Future of Money and Wealth, which is really about looking at what's going on in the economy. And so if you're interested in that, you can just send an email to resilientwealth@realestateguysradio.com. We have an autoresponder that'll get you what you need. And then you can stay in touch with us that way. And so I think that's a wrap. I'm going to try to close this down and get back to the screen. Yay. Okay. And then I stop the share. Is that right?
Exactly.
Ta-da.
All right.
Okay, guys. Sorry I was so long-winded. Hopefully that was worth the time, and anxious to hear what people thought and answer any questions that I can answer.
Yeah, absolutely. And first, just let me commend you for getting through a lot of great material. Trying to boil down a complicated topic into just an hour and a half is very hard, and you did a great job of it, Russ. Yeah, so what we'd like to do in the remaining time we have is get through some of the great questions that have been asked, and I'm sure folks are going to continue to ask more as I'm talking here. You know, just like the presentation, there's no way we're going to get through all the questions that folks are going to have here. Just as a reminder to folks, this is first in a series. One of the last slides Russ showed was the following series that are going to be coming along here. So we're going to have plenty of time to delve into each of these topics as we get through each webinar. But to kick things off here, Russ, Betsy Ames asked a question early on that I think was on a lot of folks' minds, which is, how do we know when it's the right time to buy?
Well,
it's a difficult question.
Timing is so interesting. 20 years from now, it's going to be 20 years from now. I think most people would look back at any 20-year period of time and go, I wish I would have bought real estate 10 years ago or 20 years ago. And so anytime you find the right deal is the right time. So the first thing is you being ready as an investor and understanding what it is you're trying to accomplish and what you want to build, and all those forms of capital and what you're willing to do and what you're not willing to do. So Robert will talk about that next time, personal investment philosophy. Second is getting the right people around you so that you're well supported when you decide to make the investment. You don't want to be out there looking for a property manager and a CPA who understands real estate or a mortgage person after you're in a deal. You do all those things ahead of time. So get your team in place, pick your market. Pick a market that you think is likely to do well in the circumstances that you see coming. Robert Helm says all the time, live where you want to live, but invest where the numbers make sense. Markets, like people, have personality. Some are more equity growth, some really cash flow, some are very stable, some are a little bit more volatile, some depend very much on certain industries, some are more diverse, some are more likely to benefit from hard times, some are more likely to benefit from good times. And so you can take a look at your own crystal ball and make a decision about where you think is the right place to invest based on what's going on in the world. And then you go there and you build your boots on the ground team, the people who are going to help you find the property, manage the property, fix the property up, and all of those things. And then you ask them to help you pick the property. And then if the numbers make sense and you have all those other things in place, it's the right time for you.
Okay. And I know we're going to get into this in more of the math webinar, going through the math, but are there some general benchmarks that you look at to help determine levels of overvaluation or undervaluation? Maybe it's price to rents, maybe it's price to income, sort of like the equivalent of a PE ratio for stocks.
Yep.
Are there some basic ones that you look at there, just to toss a couple out?
Yeah, absolutely. Absolutely. One that most people don't pay any attention to, and first of all, that's a great question, by the way, is gross rent multiplier. So if you were to look at a property, let's say that is grossing $100,000 a year and it's selling for $1 million, your GRM is 10. And so you're buying the gross income for 10 times, you're buying the property for 10 times the gross income. If that gross income were to increase to, if the gross rent multiplier were to increase to 15, in other words, 1.5 million for the same 100,000, now your GRM is 15. That's like a PE ratio. When you start to get to GRMs that are up, over 12 or 13, based on whatever the going rate of financing is, you're starting to get heated. But like sectors in stock trading, different types of real estate have different GRMs, and you kind of get familiar. You'll recognize when you're studying a marketplace when a property is out of whack. When GRMs are rising, it tells you that prices are going up, but rents aren't. That means that income is speculative. They're bidding up the price of the property, hoping that the future income will cover it. Sometimes it happens when interest rates are dropping because people can, afford more. But my rule of thumb when it comes to financing is, obviously the yield on the loan has to exceed the cost of the loan. I'm talking cash flow, just rate. I mean, I'm looking to make money on a spread. If I buy a property that is cash flowing at 8%, that's gross rents less vacancy allowance and operating expenses and set asides. And then I have my net operating income, and let's say that's 10%. If I can take 10% and I can go borrow money at 6%, then I make 4% spread. Okay, maybe that makes sense. And so cap rates is another way people look at it. So the way the numbers work is you have your gross rent multiplier, which is easy to look at a market and see what's going on without knowing anything about what's going on under the hood. So that's just gross rents. Then you have net operating income, which is understanding how that property is operating in terms of expenses to gross income and what you're getting from operations before debt service. And then you have debt service, which gives you before tax cash flow. And then you apply your tax benefits and you get before tax cash flow. But when you're just trying to look at a market and get a feel for the direction of markets going and when things are getting overheated, the simple metric is gross rent multiplier.
Okay, great. A couple of questions from several different folks here boil down essentially asking the same question. If we're expecting that as the everything bubble begins to deflate, that we may see some price corrections amongst a number of different housing markets.
Let's hope so.
Yeah, let's hope so. Well, where do you see, what types of opportunities do you see this making available? Right. So let's say you've got a market that's very overpriced, like the Bay Area or Australia or whatnot. Where would you be looking most? Would it be just general single family home projects? Would it be properties that benefit from downsizing?
So I think philosophically, first of all, I wouldn't be in markets that just you couldn't make the numbers work and to control the property with the income. So even though there would be a lot of potential for capital gain, like a Washington, D.C. or a Seattle or a San Francisco, very, very difficult to make those properties pencil. Unless you put in just gobs of money and you just are using it as a place to store assets. So if you're using real estate as a place to store wealth, and then then that's great. You can just go pay, and you don't care because again you're holding it long term. If it drops, that's great. If you're looking for properties that you're going to use financing for, and you have to make sure that they cash flow, then those are going to be different markets. They're going to have different personality types. In any economic cycle, there's going to be winners and losers. And so in an economy where asset prices are falling, people who have purchased properties heavily leveraged with negative cash flow, they're going to be vulnerable. So those properties are going to get foreclosed on, and that's a market you would start paying attention to because there's probably going to be deals coming out the other end of that foreclosure process. Now, I don't go buy foreclosures. What I do is I look for what I call turnkey providers who buy the foreclosures, fix the property up, get it tenanted, and then turn it over. So they buy the skinny cow, the sickly cow, they fatten it up, they clean it up, and they hand it to me, and I just milk it. Or they hire somebody to milk it for me and just send me the milk, right? And so that's kind of the difference there.
Okay, and that's a great point. I just want to jump in here because a few other questions we were asked essentially ask, I'm interested in investing in real estate. I don't necessarily want to manage it myself.
Of course you don't.
How can I leverage other experts to invest in real estate? So you're referring to that in many different ways. I know there's syndication, which is something that I'm sure we'll talk about in depth.
Yeah, two basic ways to do it. I'll start with the latter, which is syndication. As a passive investor, meaning you're just going to be a limited liability member in a limited liability company, you're going to turn your money over to someone who is the manager, who is going to go purchase the property. And so let's say you're going to go buy a $10 million apartment building. You're going to put $3 million in. You don't have $3 million, but 30 people each have 100,000. And so you guys all go in and you own 1/30 of this apartment building. The manager secures the financing, runs the rehab, does the whole project. So that is a way. It's like a REIT, but you have a personal relationship. The asset isn't in a publicly traded casino. There's not layers and layers of people between you and the profit. It's very flat. That's a way to do it. And it's a great way to do it. If you want to be only investing in your own account and you have the means, to me, the way to do it is you start with your personal investment philosophy. You pick the market that you think has the right characteristics for the type of result you're looking for. And then you go and the right economic drivers. And then you go into that marketplace and you find a team. And the most important person on your team is the property manager. People disrespect the property manager like you can't believe. It's the most important person. And what you do,
Kenny McElroy early on, that's where he started, right?
That's it. You start with the property manager. The property manager knows the neighborhood down to the door. You're never going to have the intimate knowledge. They have their thumb on the pulse. You can do all of the internet search you want. You can look up all of the charts and graphs and past history that you want. But what's happening in the market right now, which is the extrapolation point between the past and right now, so you can project the future, is the person, that man or woman in the street that's dealing with the tenants, that knows how many apps are coming in, the caliber of the tenants, whether they can push rents, and where the war zone is, where the area is gentrifying and coming up, where it's declining. All those things the property manager is going to know. Just remember, your property manager makes money based on the rents. So they're going to get a percentage of the rent for managing the property. That's fabulous. What I do is go in and ask the property manager, Mr. Property Manager or Miss Property Manager, what can I put in your portfolio that will help you be successful? Because when I do that, they're going to tell me what to buy. I don't care. It's a widget. The person who cares is the person who has to deal with it day in and day out. If I pick the right market for the right reasons and the property, inspects and all that and has basic good bones, then and I buy it at the right price so my numbers all make sense, then the key is that cash flow's got to come in. And the property manager is the person responsible for developing that. And so the easiest way to hold them accountable to is let them help you make the call.
Great. All right. Well, look, we're coming up on the 2-hour mark here. As I said, we're not going to be able to get through all the questions that folks would love to ask today, but that's okay because we've got many more episodes coming up with Russ. I do want to close just by highlighting the alert that I put here in the chat window. So Russ had earlier mentioned the different topics that are going to be covered over the next couple of episodes. The next one is on the 4-step process to real estate investing. It's going to be largely led by Robert Helms, who's Russ's partner. That's available for $50 per person. But the good news is we're offering the folks that are watching this webinar a $20 discount. You can buy it at $40. If you click on the offer that I have there in the chat window, you can go sign up for it now. If you've had to leave or you're watching this on the replay video, we're going to keep that offer for the next 72 hours. So that should go through, if I'm doing my math right, February 11th. So hopefully we can get you guys in there at the 20% discount. We'll do that at every episode. In other words, the folks that actually watch an episode will have the opportunity to buy the next one at a 20% discount. So hopefully that works for folks.
And I hope everybody does it too, Adam, right? I mean, what's the value of just one good idea? Just one.
Well, yeah, and somebody here, I was really glad to say, they were amazed that we were giving away this much material, even just on this first one for free, where they said you have to pay hundreds of dollars to go to a real estate seminar to normally learn this type of stuff, which you do. And I really want to thank you, Russ and Robert and Abstentia, for being willing to bring your expertise to our audience and be so generous with your knowledge. I've sat through a number of your presentations. They're excellent, but I always learn something new every time I listen to you. So with that, we're going to wrap things down on this particular webinar. Like I said, if you had to hop off, everybody's going to get the replay video of this in probably 4 or 5 hours. And if you have any questions about the next seminar or whatnot that we haven't addressed here, just email us at support@peakprosperity.com. We'll give you quick answers. I also put up about 15 minutes ago a link to the different resources for the real estate guys, including their website, their podcast, learning more about the Summit at Sea, where you can get their excellent book, Equity Happens.
Well, good luck with that. I can't get it.
Yeah.
It's out of print.
It's out of print, but it's still available. You can go to Amazon and buy an out-of-print version. But Russ, is there a particular URL or email address? I think you might have mentioned one earlier, but if folks have particular questions that they want to ask of you in the interim?
Yeah, I mean, the best way to contact us or get to know us is just get on our list. So if you send an email to resilientwealth@realestateguysradio.com, the auto reply will send you links to, the website, the show. And so instead of you going to the website, having to dig around, it'll take you right to each of the different things. Best way, we have an Ask the Guys deal on our website, which means if you click Ask the Guys and ask a question, that goes into a database, and every 6 to 8 weeks, Robert and I open up the mailbag and answer those questions on the podcast. And we're toying with actually expanding our YouTube channel and doing some more Q&A like this, on the YouTube channel. So, I'm not super techie, so we're trying to figure that out. But we'll be doing that. And then the other thing, come to a live event. I mean, if you really want to get a chance to hang out with us and our tribe, I mean, take the big bite and come on the Investor Summit at Sea. It's only once a year. It's coming up fast. And it's fabulous. I mean, if I say it, it's sales pitch, so I won't say too much about it, but I'll let Chris and Adam tell you about it, or ask Robert Kiyosaki. He's coming back, going to be on the ship the entire 9 days. He's staying the whole time. It'll be fun.
Fantastic. So real quick, just some timing issues. Somebody asked when the next episode of this series is. That's going to be Saturday, February 23rd. You just mentioned Summit at Sea. What are the actual dates for that, Russ?
March 15th through the 24th. So you got to get into Fort Lauderdale on the 14th. And we start the next morning in the hotel. We get on the ship that afternoon, and 9 days on the ship. We're going to Aruba, Curacao, Bonaire, and Grand Cayman. And again, Chris and Adam, G. Edward Griffin, Peter Schiff, Robert Kiyosaki, whole bunch of niche experts you may not know, but they're great in their niche. Brian London, gold expert. Gold is a hot commodity. We are going to be talking oil again this year. Turned out to be a really good call. Probably, guys, I've maybe got one of your oil guys we might want to try and get on too. So if there's still time. Anyway, it's going to be fabulous. So it's a big bite out of your schedule, I know, but really it's a bargain. You'll get more done in terms of deepening your financial education, building your social capital, and in a week, or a little bit more than a week, than most people get done in 10 years. And at the rate of change right now, I don't know that you can really afford to wait 10 years to take your education to the next level and build the kind of social capital you can build on the summit. So, if you're a believer in everything we're talking about, I would grab it.
Yeah, and I do want to underscore too, what's unique and incredibly valuable about the experience at Summit at Sea is the access that you get to the speakers. You're literally hanging out with these people and socializing with them for a week straight. So, in many cases, if you've, been a huge fan of Simon Black or whatnot, you're not just seeing him up on stage. You're actually able to have dinner with them and play shuffleboard with him or whatever you want.
Simon's coming. He never tells us until the last minute. So we're not sure Simon's coming. All the other people I mentioned, we know they're coming.
All right. And then lastly, too, just in terms of attending live events, both Russ and Robert will be presenting at the Peak Prosperity Seminar the last weekend in April in Sebastopol, California, April 26th to 28th. So whether or not you're able to catch them at Summit at Sea, you can also catch him at the Peak Prosperity event. All right, we've got to wrap things up. Chris, anything to say in closing?
No, thank you so much, Russ. It was fantastic information. I concur with everybody who said it was really highly valuable and very important. And I think it's great to be able to deliver information here across the web where, it's fun to get together and travel and all of that. But boy, from a cost and time standpoint, this is a great way to just share information. And as well, I would remind anybody, if you're personally interested, that's great, but you will have this recording and you would be able to share that with any of your friends, family, children. I'm going to be sharing this with my own kids because this is just really, it's a fabulous asset investment area to know about if you do it right. And I'm just really disappointed that my own family didn't have that legacy and teach me about this early. So I'm catching up, making up for lost time. And it just feels very important because this is an area that's tax advantage. The government wants people to have places to live, so they make it worthwhile. And so it's a great place to really begin to explore and learn how to have it work for you. So with that, thank you everybody for coming. Thank you for listening. And we're really excited to be able to offer this. And the questions that we didn't get to, we will see what we can do to get to those in other places. We had important questions that came up for us. Just so you know, somebody wanted to know the real estate meltdown happening in Australia. Does that present any opportunities? What do you think about that? And so we do want to talk about the boom times, the bust times, and what you should be doing in each of those because we feel that there's potentially a bust time coming up, and that's an area that presents opportunities if you know how to be participating in that. So with that, thank you, Russ, and thank you everybody for coming and joining us here today. Hope it was worth your time. Certainly was worth my time. So with that, I'll be signing off. Adam?
All right. Thanks again, everybody. That's it. The replay video will be going out in about 4 or 5 hours to everybody. Russ, thanks one last time. And everybody, we hope to see you on Saturday, February 23rd for the next installment.
Thanks, everyone. Thank you.